I want to move out from mutual funds into stocks. More often than ever, I hear this from investors. Welcome to Mera Paisa Kahan Gaya, a video which tells you how you can actually make more money. I'm Rin Agarwal. I'm a financial educator working towards helping people achieve financial freedom. So what's happened with the SIPs? Yes, SIP returns are not looking that great. All of a sudden, it's very boring to sip. In fact, it seems to be better to gulp now. People are seeing very low returns as far as their SIPs are concerned. And then, of course, you hear all these stories from your friends, your family, your colleagues about how they have been just raking it in with stocks. And you start thinking, have I done the right thing by investing into a mutual fund? Why am I paying so much of fees? Why don't I just go out there and I just do things on my own? I mean, after all, it's so easy. Everything is just electronic. It's just with a click of a button. I can track it on my phone. I can exit it when I want to. So why don't we just ditch the funds and buy stocks? When investment decisions go right, you feel very happy about it and you want to magnify it. But when you're investing over a longer term period, you find it very boring, it's taken for granted, and it certainly does not give you a high like a recent investment. That's also another reason why people are looking at getting into stocks. Well, couple of things. First and foremost, when you are comparing your fund returns with your stock returns, remember that as far as the fund returns that you're comparing, those are over a couple of years, whereas you would tend to compare it with stocks which are only for a few months. So you're comparing returns in funds over a couple of years with returns from stocks over a few months. And remember, you might be comparing a portfolio which has a combination of stocks and bonds with just pure stocks. So that may not be the right thing to do as well. Again, comparing a basket of equity investments with a single stock is not right, because you might have mid caps, you might be having some small cap stocks, and then you're comparing it with a large cap stock. So again, that's not the right comparison, because different types of stocks move differently at different points in times. So before deciding to move into stocks or ditching your mutual funds for stocks, you need to ask yourself a few questions. Are you willing to allocate a larger part of your portfolio into stocks? It's easy to just do trading with some smaller amount and, just buy stocks based on tips from friends. Do you really think that you can allocate large quantities for this? Do you think you can actually afford to actually gamble away with larger amounts in these sort of investments? Are you going to be actually able to time the market correctly? The best example I've seen is that in March, when the markets were down by 35-40%, nobody wanted to invest. In our sessions, we kept getting questions asking us, should we exit from our investment? It's down by 40%. And then actually when the markets were going up, when they went up by 10-20%, then people started exiting thinking, ये market तो फिर से गिरने वाला है, so might as well I protect my downside. And look what happened. The markets are up by almost 40%. So do you really think that you're going to be able to consistently deal with this sort of volatility on a regular basis? And can you actually identify the winning stocks? I mean, today if you see, there are a handful of large cap stocks that are actually moving the index up. The larger spectrum of stocks is actually not performing. So how are you going to actually pick up those winning stocks in your portfolio? Are you going to be able to regularly invest or not? And more importantly, are you going to be able to measure your performance against the right benchmark? Remember that the performance of an individual stock is not the indicator of return for the entire portfolio. And you would still need to review your entire portfolio. You cannot only look at one stock and feel very happy about it, but you'll have to look at your portfolio from an overall basis. When you're investing in stocks, Can you actually be well diversified? Often I have seen that people are actually not able to diversify themselves because they basically go after the best performing stocks or the stocks that have given near term good performance, and hence they're really not able to identify stocks across different companies and sectors. Like right now, I see one or two stocks, or I see the pharmaceutical sector is what people are really going after, but they're not diversifying. Again, with large caps doing well, everybody is focusing on large caps, but they're really not diversifying among mid caps and small caps. And remember, large caps might be doing well now, but there will be a time when mid caps will certainly start picking up. And if you have not chosen them, then you are certainly going to miss out on the initial rally, which is when you can actually make the highest amount of return. Finally, by investing in stocks directly, are you going to be able to meet your financial goals? It's really strange when we talk about 15-year financial goals. People seldom want to lock in money for 15 years. So if you're buying stocks on a regular basis, and stocks can be extremely volatile. And if you just have a bunch of stocks in your portfolio that you're looking at for a 15-year goal, do you really think that you'll be able to achieve your goal? One of the reasons that I think funds work very well is because it's a basket of well-researched stocks. Again, it is not one person's opinion that counts, but it's a collective decision. There are processes in place. Many times, for example, when stocks start falling, people tend to always hold on to the losers and they only exit the stocks that are doing well. So what happens if you're just left with an entire portfolio of dud stocks? What are you going to do? You're just going to exit at a loss. That's not really going to help you meet your financial goals, right? So hence, I think sticking on to funds is a better idea, because with stocks, one, identifying the winning stock, remaining invested, or even figuring out when to exit from that stock, achieving diversification across sectors and companies and market caps is not exactly very easy. And finally, to have the time to take all these decisions and to monitor your portfolio is extremely tough. Honestly, not too many individual investors actually make money in stocks on a long-term consistent basis, and hence we should just leave money management to professional fund managers, which are really the mutual funds. As far as costs, there is so much of talk on costs that the mutual funds are charging me so much. Honestly, you're paying 1 or 1.5% in a good equity fund, in a large equity fund. It's not too much of a cost compared to what you're probably paying in your insurance policies. So the next time you're thinking about moving to stocks because you feel mutual funds are charging you high, maybe the first thing you need to do is actually exit your ULIPs. So my take, remain invested with the mutual funds itself. Do check out our videos and do subscribe. We do look forward to your feedback. Cheers.